Unit 3. This is actually one of my favorite units on shadow banking, and there's going to be a lot of shadows in this unit. And in Unit 3, I'll be talking about financial stability, bank structure, and shadow banking, and focusing on whether commercial and investment banking should be joined or separate, and whether shadow banking is a good or a bad thing. On shadow banking, I just want to say, like, I feel like there's two aspects to shadow banking. There's the shadow banking, which is used for regulatory arbitrage, which I'll be focusing on in this unit. But because I'm in the private equity and venture capital space, I have to say that, you know, private equity firms and REITs and venture capital, well, not venture capital, but really private equity firms and REITs are seen as part of the shadow banking industry because they do some functions of banks but are not regulated like banks. But that's very different from the SPVs and the hedge funds that I'll be describing in this unit, that typically during the global financial crisis were used for regulatory arbitrage. We don't see that to the same extent or at all in the private equity industry, just to make that clear. So, introduction. Regulatory reform has evolved to recognize not just the stability of the banks and the banking system, but also what the wider financial system, and that includes shadow banks like hedge funds, like SPVs, like private equity funds, like REITs. And the shadow banking was used for regulatory arbitrage during the global financial crisis. And that's why I think it was so important to include it and talk about it as part of the wider conversation about bank regulation. Since the global financial crisis, there's also been a resurgence of the debate around these universal banks that combine commercial banking and investment banking. And I know in Nigeria also there's been developments, or they say that the banks have caught holdco fever. So all the banks are merging into these like super banks where they have their typical retail, but they also have payments, they also have insurance, all under the group. And that introduces a level of systemic risk that regulators have to be aware of. So commercial and investment banks, should they be joined or separated? The Glass-Steagall Act is a really famous act, United States, 1933. There were other restrictions in the UK as well. And the Glass-Steagall Act separated commercial banks from investment banks for most of the 20th century. But over time, the Glass-Steagall restrictions were broken down and gradually abolished. And that reminds me of a really interesting quote. I don't know where it's from, so I can't source it. But somebody said that, in case you don't know, Enron was a company that, you know, was at one time one of the biggest companies in the United States. I think it was a power company, but eventually, with a huge scandal that actually took down one of the big five at the time consulting firms, because Arthur Andersen was one of the accounting firms, actually was the reason why that firm also was destroyed, because they were the auditors. And so wrapped up in a huge scandal, basically. And it reminded me of a quote that somebody said about Enron. They said that Enron employees were smart enough to circumvent the rules, but not wise enough to understand why the rules were put there in the first place. And I think with the breakdown of the Glass-Steagall Act, as it was broken down, I think that perhaps there wasn't the realization of why that rule was made in the first place. You see, investment banks are able to buy and sell securities and other financial assets, and they trade on behalf of clients, but they also operate their own proprietary accounts, so they trade on their own account as well for themselves. Now, commercial banks are very different because they deal with depositors' money, that's citizens' money, and therefore they have an implicit government guarantee. So their regulations are necessary to make sure that banks don't use the privilege of that government guarantee, which I'll be talking about in subsequent models and how it creates units, how it creates moral hazard, because they take advantage of that sometimes. But yeah, they shouldn't be using that privilege to finance risky trading on their own account because they know they'll be bailed out. Risky trading, investment banking, should be wholly financed by the bank's own capital and market funding at rates that aren't subsidized by the government. And that's why it was recommended at the time the Glass-Steagall Act was passed to actually separate investment banking from commercial banking. Actually, the Siamese twins in this picture were eventually separated, even though it was difficult. And I think the question that I'll be leaving you with is, do the Siamese twins of banking, investment banking and commercial banking, need to be separated as well, as difficult as the operation may be? So because of the global financial crisis since 2008, the United States has actually passed reforms to partially reinstate the Glass-Steagall Act. And this was due to the fact that many people believed that the expansion of investment banking, unseparated from commercial banking, contributed to the global financial crisis because they created and traded all sorts of securities like collateralized mortgage obligations, etc. And in the UK actually intends to adopt similar rules called the Vickers reforms, also around separating and requiring banks who are Siamese twins, so who do investment activity and commercial activity, to sort of ring fence away their investment activity around the separates and ring fence investment activity from the commercial activity. But neither the Vickers reforms or the Volcker rule or the Glass-Steagall rule actually, neither the Volcker rule or the Vickers reforms, these new ones in America and in the United Kingdom, actually are as strict and as stringent as the Glass-Steagall Act of 1933. So we've spoken about commercial banking versus investment banking, and whether there should be universal banks or whether their activities should be separated, and how much and how far-reaching the separation should be. And I'm going to talk a bit about shadow banks. This is actually a picture of Kim Kardashian at the Met Gala 2021, so this year, and I thought she looks a bit like a shadow, so I thought this was a nice picture to begin this discussion. The Financial Stability Board, the FSB, which you'll be hearing about later on, defines shadow banks as a system of credit intermediation that involves entities or activities outside the regular banking system. It's not regulated, and that's one of the alternative definitions, that these are financial institutions performing bank-like transactions but not under typical banking regulations. But so they're not regulated, and therefore they can take advantage of financial innovation a lot more quickly than a bank could. They're not subject to capital adequacy requirements. So remember in the last module when we were discussing Basel I, the initial even Basel requirement had an 8% capital requirement, meaning that you had to keep a certain amount of capital within the bank, whereas shadow banks aren't subject to these capital adequacy requirements. So obviously they spend all of it, they loan it out, they trade with all of it, and therefore they're highly leveraged, more so than a bank would be. And they're often typically located offshore, and I'll be speaking about offshore financial centers in the final unit, but they therefore enjoy tax and regulatory advantages of being offshore as well. So they're not as heavily taxed if they're in an offshore financial center, and also they're not as strictly regulated. Even though I said that there's no regulation for them as banks, there's regulation for them as companies in their home countries, but even those regulations don't affect them if they're located offshore. Now, textbooks say that there's two main reasons why shadow banks exist, but because people include private equity and REITs in the definitions of shadow banking, I beg to differ. But in the context of SPVs and hedge funds, um, there are two main reasons, two sort of main sort of reasons, I guess, why shadow banks emerged, especially the shadow banks like the SPVs that I'll be speaking about in the next few slides. They emerged because of specialization, so a natural tendency towards financial innovation. And I think that that's the kind of pot where you'd find the PE and the VC firms, right? It's just a more specialized form of finance. And you actually find that banks that go into private equity actually have worse outcomes, far worse outcomes in terms of failure of the companies in their portfolio, despite the fact that they have access to cheaper capital than you would see in a specialized private equity firm. So a natural tendency towards financial innovation is one reason why shadow banks exist. And then the second reason, which I kind of have been defending since I started this module, is regulatory arbitrage and lower cost. And there is a bit of that. I mean, private equity firms are typically registered in tax havens because of the lower cost. And I think, that, yeah, the shadow banking industry does engage in a form of regulatory arbitrage because there's a natural tendency in any industry to want to lower costs. So SPVs, what are SPVs? SPVs are vehicles, special purpose vehicles, where that were originally actually created by banks as a way to get around regulation. So a lot of assets or a lot of income streams that they did not want on their books, they put into these SPVs. And the key features of an SPV is, usually established by a bank and usually operated by it. It's actually legally separate from the bank. And then the special purpose vehicles buy mortgages from the bank, buy assets from the bank, um, buy loans from the bank, etc. And what that does is it's very tricky. You know that there's certain ratios that the bank needs to keep. So they created these SPVs really to be able to put some of those assets, like almost like dump them within the SPV so that they could still look as if they were sticking to the regulatory thresholds, whereas they were sort of circumventing them through these SPVs and creating these like separate entities to put all of these things in. So this was a form of regulatory arbitrage. And then to finance these assets, the SPV creates and issues these loans into securities, right? With defined risk and returns criteria, which are then sold on to investors. So if they are separate legal entities, like I said, how do they create systemic risk? So if the bank provided credit to the SPV during the global financial, so number one, how they create systemic risk is if the bank provided credit to the SPV. So if the bank had extended credit to the SPV and then the SPV or the assets in the SPV go bad, then obviously it's affecting banks' liquidity, right? And then during the global financial crisis, even though they were separate legal entities, investors knew that these things were leaked to certain banks, so they didn't care that there were separate legal entities. People still put pressure on the banks to pay them back their money. Um, so that's sort of the reason why, even though they're separate legal entities from the banks, they can still um, create systemic risk. Well, the Axel Rod. This is actually the most appropriate picture to talk about hedge funds, and I'll just go through this very quickly. So, hedge funds take a variety of forms, specializing in a variety of specialized styles and strategies. But the whole aim of a hedge fund is making high returns over a short time horizon. Their common features are they don't accept back deposits, so they won't take money from you and me. Um, and they're not subject to bank regulation, and they're usually very, very highly leveraged. And they use money typically from banks, pension funds, and high net worth individuals. So I think the point people realized, or regulators realized, that hedge funds could be a problem was when a large hedge fund led by finance experts, Nobel Prize winning financial experts, collapsed in 1998, generating a serious risk to the banking system because banks had their money in them. And the disaster was only averted by quick action of the Federal Reserve and bank supervisors. Um, and in 2007, some of the first signs of that global financial crisis and the solvency and liquidity problems were actually seen in hedge funds and in the SPVs. So actually, people said that the global financial crisis actually started in the shadow banking system. So we touched on how shadow banking can increase systemic risk, but I'll talk about it here again in detail as we close this unit. And there are at least 5 ways that shadow banking activities can contribute to systemic risk. Number 1, hot money. We've seen quite a bit of that in Nigeria. And I mean, hot money inflows. The reason why some countries like Chile, for instance, and Thailand actually had to institute capital control. No, it wasn't Thailand, it was Malaysia. Had to institute capital controls was because of these flows of hot money from regulatory. One of the ways that shadow banking activities can contribute to systemic risk is through excess capital mobility, right, from regulatory arbitrage. So shadow banking activities can lead to global financial instability related to this rapid sort of short-term capital flows to offshore financial centers and then back home whenever sort of taxes or disclosures or even elections happen, right? They can bring money out and bring money in so rapidly that it causes instability. And countries like with low tax rates, like Ireland, Iceland, Cyprus, experienced really significant boom and bust cycles related to inflows and outflows, sudden inflows and outflows of hot money. The second is neglected risk and the opacity of these debt contracts, right? Neglected risk comes into play when investors systematically avoid or ignore the worst case scenario and overprice assets during a boom, which is typically happens in boom periods. A good example of opaque debt contracts is where contracts, the collateralized mortgage obligations sold by SPVs, there was actually very little information about the underlying assets. And if you watch The Big Short, right, there's so many humorous, scenes when people that were selling mortgages were going into trailer parks, like literally people that were making maybe $5,000 a year and selling them like $1 million houses, right? But nobody really understood the underlying assets, which was sort of highly leveraged, and they were selling houses so fast that they were sort of heightening the chances of a default significantly. So yeah, the neglected risk where assets are overpriced during boom periods, during the good times, and then these shadow banking securities are actually traded. Um, you don't really know what lies beneath them. And number three is around funding fragilities. So for shadow banks, the assets funded have longer maturities than liabilities. And in addition to this, they're less liquid. And there's no deposit insurance, so the funding sources are uninsured. So a run on the shadow banking system produces a fire sale situation where assets have to be sold as a discount. And when assets are sold as a discount, asset prices then fall, paranoia spreads, it deepens the run, producing a contagion, and then an increasing number of wholesale investors request their funds, turning it into sort of a vicious cycle. The fourth way that the shadow banking activities can contribute to systemic risk is due to leverage cycles. So during booms, asset prices are high, but in busts they are low, and therefore the leverage cycle actually amplifies the shocks. And then agency problems, the transfer of credit risk without the complete transfer of information, like I described earlier, you don't know what's on there, creates agency problems, leading to inefficient outcomes. And this is especially true when there's sort of a long train of intermediaries. It kind of ends up like Chinese whispers, where you really, somebody has sold it to somebody who has sold it to somebody who's chopped it up again and sold it to somebody else. And it's almost impossible to find out what the underlying asset is or what exactly you're buying. And rating agencies should have solved this problem, but actually they have had their own agency problems as well. So there's been various attempts to regulate shadow banking. Basel III asks specifically for heavier weightings for securitization and off-balance sheet vehicles like the SPVs, so that those SPVs can't be used as easily to circumvent the capital requirements. Because remember, I said the point of the SPVs was putting all those assets into the SPVs. Banks were putting all of those assets into the SPVs, which were separate legal entities, and then making it look so that they could look like they had lower leverage ratios. But now Basel III is specifically asking for them to declare that. And then Dodd-Frank has argued that it doesn't specify targets for capital requirements, as it was argued that the US should wait for the results of the Basel III negotiations. They were worried about competitiveness, right, which is another issue, which is that if you over-regulate, then the banks will move their headquarters elsewhere. The general acceptable accounting principles gap were very good. Standards on consolidation of SPVs were tightened, and as soon as they did that, actually, $1 trillion was repatriated back onto balance sheets from these vehicles. So that was definitely a success in terms of the regulation of shadow banking. So there's been a few attempts in the EU as well. There's been a few attempts in terms of IFRS 10, 12, and IAS 28 concerning the valuation of securitization and also this consolidation of the SPVs. Conclusion. I think with regard to shadow banking, large countries have different attitudes to small countries. I put a picture of Mauritius in the back. So large countries, as I will be explaining sort of in the final unit, actually benefit from because the money that the shadow banks bring into the economy can sort of suffice for their population. I think they have a very different attitude to the larger countries on shadow banking. Remember that shadow banks have no capital adequacy ratio, so they tend to be highly leveraged. And then remember these relationships as well that I spoke about between banks and shadow banks, especially SPVs and hedge funds. And then lastly, in this module, right at the beginning, I spoke about the disadvantages and advantages of separating commercial and investment banks. I hope you enjoyed that, and we move on to the next unit. Macropru. Macroprudential regulation is one of my most exciting topics because I think it gives a much broader perspective on the financial system of a country compared to looking at regulation through a solely microprudential lens. And I hope that when I finished explaining, you'll agree with me. During this unit, I'll be talking about the motivation for macroprudential regulation, why would you have macroprudential regulation in addition to microprudential regulation? How does it work with other policies and internationally? Does it work at all? So after this unit, you should be able to kind of explain the role of macroprudential policy as part of your policy tool or regulatory toolbox. All you need to know about macropru. So I decided to start with the summary slide because there's only a few things that you need to know about macropru. Of course, I'll break them down in the rest of the unit. But if there were three things, if there were sort of a few items that you needed to remember, this would be the key, these would be the major keys. When it comes to bank and financial institution regulation, there are two things involved: macroprudential policy and microprudential policy. When it comes to macroprudential policy, there are two things involved: systemic risk and procyclicity. When it comes to controlling systemic risk and procyclicity, there are two things involved: restricting demand for credit and restricting supply of credit. These are the golden rules. So let's bear this in mind as we go on. What are macroprudential policies? Macroprudential policies, according to the Brookings Institute, are financial policies aimed at ensuring the stability of the financial system as a whole to prevent substantial disruptions in credit or other financial services needed for stable economic growth. Where macropru fits in. So previous units have focused on individual banks and kind of not really focused on the risk of the whole, or what we call systemic risk. But in the light of the global financial crisis, policymakers realized that additional measures were important. So macropru takes into account the feedback effects of behavior of individual financial institutions on each other, as well as the whole economy. And I've put like dominoes there because sometimes, you know, the behavior of an individual bank can kind of like feed through a series of financial institutions, leading all of them to collapse. And that's what macropru tries to prevent. And it looks at that whole picture of many dominoes as opposed to just one domino on the table. Macroprudential policy targets two sources of risk: systemic risk and procyclicity. Systemic risk originates from the behavior of individual institutions, but has consequences for the entire system. Procyclicity, due to the fact that economies don't progress linearly, but they progress in boom and bust cycles. And banks mirror these waves by taking more risks in the boom periods when asset prices are high, and then rapidly cutting down when asset prices crash. And this is a risk, this rapid sort of wavy sort of behavior, and macropru tries to even that out. Macropru is all about externalities, and here is a picture from Nigeria, actually from the oil producing region. And as you can see, the water in these regions, I mean, it's a riverine, a lot of them are riverine and swamp areas, and the water is polluted with oil, and a lot of people that made their livelihoods from, say, fishing or other riverine activities that actually had their whole lives destroyed by oil exploration. And this is what we call an externality. Externalities refer to situations where the effect of production or consumption of goods or services, the effect of production of goods or of production or consumption of goods and services imposes costs or benefits on others which aren't reflected in the prices being charged for the goods and services provided. And externalities associated with the activity of financial intermediaries can lead to systemic risk. So the externalities related to strategic complementarities that arise from strategic interaction of banks and cause the buildup of vulnerabilities during the expansionary phase of the financial cycle. Then externalities related to fire sales. I can remember speaking about that in a previous module unit when I said that these fire sales arise from the general sell-off of financial assets, causing a decline in asset prices, deterioration of balance sheets, and that's especially during contractionary phases of the financial cycle. And then externalities related to interconnectedness, propagation of shocks through the financial systems, um, and the correction of these externalities can be seen as intermediate targets for macroprudential policies. So it's policies that control externalities, mitigate market failures that cause systemic risk. So interconnectedness externalities are particularly strong in systemically important financial institutions and globally systemically influential institutions. And those banks are really, really, really difficult to wind down. People complain about bailouts, but they're really complex to wind down. They operate in several jurisdictions, they provide you services, and they're the backbone of the financial infrastructure, making them kind of too big to fail. And interventions historically have been to give de facto bailouts to them to protect creditors, and sometimes even shareholders and management from the full scale of the losses. But the very fact that governments bail out these banks makes these systemically important financial institutions take up more risk. And it becomes a race to become, every bank wants to become a systemically important financial institution, as obviously it lowers the cost of funding and reduces the cost of, it reduces the effects of competition, because once you're a systemically important bank, then you're not really competing with the smaller banks, because people think that smaller banks are going to fail, so they don't give them as much as low a cost as capital as they would give a systemically important bank with, sort of an implicit or explicit government guarantee. What are the tools that are used to sort of execute macroprudential policy? So I said that it's either restriction in the demand for credit. So the most common types are these limitations are loan to value cap, or the loan to income, or the debt service to income cap. And then there's also restrictions in the supply of credit. So in terms of the tools used for that, countercyclical capital requirements, so making sure that, in boom times, there are different capital requirements to in bust times, risk weights for certain types of credit other than the Basel II weights, minimum provision rates, for instance, capital surcharges based on systemic risk, liquidity limits, FX reserve requirements, etc. That's on the supply of credit, whereas restrictions on the demand for credit, additional sorts of restrictions on demand for credit as well, limits to growth, for instance, or surcharges for individual types of loans, also sort of reduce that systemic risk. I think it's important to sort of begin to round up by discussing the relationship between macroprudential policy and monetary and fiscal policy. Definitely, expansive monetary policy can increase lending and increase risk taking, therefore increase systemic risk. And also, fiscal policy, like tax rules, for instance, can affect systemic risk. So the kind of tax rules that give tax breaks to people that buy houses, for instance, can increase systemic risk because it makes it favorable for people to buy houses. It incentivizes people to get mortgages. So that really interacts with systemic risk and with macroprudential policy. And then in the light of free movement across borders, and that's why I started by describing the Basel guidelines as sort of international in nature. International coordination around systemic risk is needed to make sure that you're not just moving risk from one area to another. But then we know because of its international nature, when one banking system collapses, the interconnectedness of the banking system, it still affects the banks in the well-regulated jurisdictions as well. So international coordinating is important. Does it work? The evidence base is actually quite light and quite mixed. There's some research that I've read that's very, very negative about macropru, but mostly I think it's now become accepted that macroprudential policy is sort of part of a regulator's toolbox. Who should be administering the macroprudential policy? Whether it's the remit of a central bank, whether it's a Ministry of Finance, whether it's a central sort of financial stability committee. Those are sort of the debates that I've also read about as well. And I think the IMF summed it up in the best way that I found. It says macroprudential policy may contribute to reducing systemic risk and financial instability based on different empirical approaches, using robust and different statistical methodologies, including cross-country panel regressions with macro and bank level data sources. In conclusion, macroprudential instruments aim to prevent the buildup of risk by inhibiting the accumulation of externalities in the good time and their dumping in the bad times, and concentration of externalities, above all in the systemically important financial institutions and the globally systemically important banks. Thank you very much.